Global Custodian recently sat down with Jeff Gooch, Head of Processing and Valuations at Markit, to talk about the process of OTC derivative valuation and the increasing trend toward independent valuation of these instruments.
Certainly. There's four key elements to what we do in terms of our portfolio valuation service. I think the first thing is to pick up the position data from our clients, and we use an XML feed to do that, because we think that gives you a better STP process and improves the accuracy of the overall result. The second thing is to build mathematical models to model the derivative positions you're looking at. We use very standard industry models, and perhaps we'll talk about that a little bit later on, but I think clearly you need a bunch of quants to build you some quite sophisticated models, but it's important not to deviate too far away from industry standards. Probably the most important thing is the data that actually feeds the models. We use a mixture of data sources here at Markit. Clearly we use our own credit data in terms of consensus pricing curves, etc. From our own internal product. We use a variety of industry observable sources, exchange traded product prices, etc. But also we use inputs from the banks on a lot of non-observable data, particularly option volatilities, skew levels, correlation numbers, etc. The final step, which is something that I think a lot of people overlook, is it's very easy to view valuations as a sort of black box type product that you kind of put some trades in and out comes the result and you're done. In practice, our experience says you're very likely to pick up errors doing that. We think it's very important to kind of sense check the results that come out of your models and spend time thinking, does that result actually make sense? And we employ quite an experienced team of analysts with a strong mathematical background that look at all of our results and just compare different trades, different counterparties from their understanding of what's happened to correlation or volatility during the month to make sure the results look reasonable. A lot of people talk about the difficulty of building models, and clearly you require strong IT and mathematical bent to be able to build appropriate models. But I think at the end of the day, there are fairly standard models out there in the marketplace that most participants use, and if you were not to use those, they'd actually cause problems in terms of the comparability of your numbers to other people, particularly from sort of finance and regulatory perspective. So we very strongly believe that on a pure model perspective, what you should be aiming for is maximum transparency on a very standard model for the market. So certainly if our clients are given all the details of our models, we don't believe it's appropriate that we give them a black box and say, here are your numbers, we're not telling you how we calculated them. I think what does make a big difference, though, is actually the data that drives the model. However good your model is, if you put poor quality data into it, you get a very poor quality output. And that sounds very obvious, but a lot of people are tempted to make shortcuts because a lot of this data is quite hard to find. Certain things, at the money option prices from exchanges you can get quite easily. Certain interest rate yield curves are very readily available. But as soon as you get into less observable data sources, correlation numbers, option skews, long-dated volatility figures, etc., it's very hard to get reliable sources for that. And you need to be very sure that the results you're getting are not based on one particular dealer's view of the numbers. In the market, we're conducting valuations for a wide variety of participants, clearly hedge funds, traditional fund managers. We also do a lot of work with the major fund administrators. Most of those bundle our services in with theirs in order to provide a more rounded offering out to clients. What we've noticed in the last few months is probably particular growth in two areas. One is the increased use of derivative valuations by US mutual funds and other traditional money managers, driving a requirement for same-day numbers given the net asset value calculations they need to do on the day, particularly for sort of 4 o'clock type numbers in the US. That's driven a lot of growth, both directly and via administrators for our business. The other thing we started to notice more recently, given market events over the summer, is a lot of hedge funds that are taking highly leveraged positions that perhaps historically have tended to rely on their own internal modelling and counterparty marks, etc., coming to us for independent valuation, primarily because a lot of those positions are very sensitive to small movements in the data. That 1 or 2 basis points on the trade can make the difference between profit or loss. I think there's a couple of things that are happening. I mean, clearly in the accounting world, there's FAS 157, which is, as you know, requiring a lot more transparency around how derivative valuations in particular are derived. Funds are increasingly going to be expected to disclose the type of transparency they have and the type of modelling they're using to get their results in their financial statements, and that can have quite serious implications in terms of if analysts, etc., are not happy with the disclosures you make. So that puts a big emphasis on pushing derivatives up to the highest quality disclosure, level 2, rather than level 3, which is driven really by taking observable data and interpolating between observable points of data. The second thing I think that is starting to change is a lot more focus around independence evaluation. You've seen in the press today that the hedge fund committee coming out with new best practices for the hedge fund industry, suggesting that hedge funds should be disclosing the methodologies they're using for less liquid positions. You're certainly in Europe seeing a lot of funds taking advantage of the usage 3 opportunities in Europe to include derivatives in more traditional products, but again, one of the requirements there is to verify your results against independent sources. So I think the combination of those two factors, both the regulatory requirement, best practice requirement, and the accounting disclosures, is forcing people really down the route of the independent source.